Welcome to the TrustleBridge Capital video series entitled Market Observations. I'm your host, Eric Jefferson, and want to start by wishing everyone a Happy New Year. For the first episode in 2024, going to spend a couple minutes talking about some of the factors we think most likely to impact the economy and capital markets in the year ahead. Now, before we get started, we have a few quick words from our legal team. With that, we can go ahead and begin. So being in the new year, we recently released our annual outlook. This goes through, summarizes a lot of what took place in the year prior, but something that we're doing differently in this version is taking a look at what are some of those leading indicators or factors that suggest where we may be going in the year ahead. We often talk about how the stock and bond markets are forward-looking, meaning they don't trade up or down depending upon whether things are good or bad, but rather are they getting better or worse. Same mantra that Wayne Gretzky once made famous: you skate to where the puck is going, not to where it is. Now, before we begin, I want to offer the caveat that obviously nobody can forecast what the stock market will do in a given trading day, never mind a period of 12 months in the future. Obviously, that's a function of so many factors that can impact risk assets as well, many that are unknown up until the point that they occur. But that being said, as we take stock of what I would argue to be the 15 most significant factors, taking a understanding of the current trends at least provides a baseline for what we may expect in the year ahead. Now, I mercilessly won't go through each line here. Do want to recap, though, the high-level takeaways. We'll start there in the first section under economy. The U.S. GDP growth coming off of a phenomenal year, well above the long-term averages. That was especially surprising given so many had called for recession. Now, we think about the trend. Some leading indicators have suggested those stellar growth figures not likely to continue in the year ahead, but we are still trending back to that long-term average of about 2.5%. Part of the catalyst for growth last year was progress on inflation. Again, we came from record highs over the last 24 months, continuing to trend down closer to that long-term level. Obviously, though, that last inch often can be the most difficult. Now, we think overall, though, what drives an economy, 70% of that is the U.S. consumer. So you can't have a strong economy without a strong consumer willing to go out and spend. In order to do so, consumers need to want to spend as well to be able to. We have seen some of the overall financial strength of the U.S. consumer deteriorate ever so slightly. That was a function of people having record savings during the pandemic, and now as the economies have opened in the years since, have gone out, have spent on things like travel and entertainment. Now, overall, though, number one predictor of a consumer's willingness to spend is whether or not they are gainfully employed. And you can see, still in a very favorable environment with respect to labor. Unemployment remains well below long-term averages. Granted, that has slightly ticked up as of late, but overall, you can see workers very confident in their ability to continue to earn a paycheck, which then translates to that positive sentiment or willingness to go out and spend. Now, as we transition, we think about the stock market. Historically, number one indicator of success in the stock market comes down to earnings. That is a function of the revenue a company generates and the profit margins that it maintains. That's what translates to earnings at the end of the day. Revenue, as you'd imagine, very closely correlated with the overall economy. Again, that is very good, but trending towards those average levels. Profit margins coming off of all-time highs the last few years. Again, slightly trending lower, though, as of late. Now, we do have a fairly negative reading with respect to earnings growth. The rationale for that is experts are forecasting a 12% growth in earnings for the year ahead. Now, that's coming off of a year where companies had virtually flat earnings in 2023. That is also 1.5 times the long-term average of 8% growth. Now, the reason that's represented in red there as a headwind The concern is if companies aren't able to deliver on those earnings, we have seen valuations tick higher. Valuations, in essence, refers to investors being more willing to pay more for stocks in anticipation of those future earnings. So having a very lofty, aggressive earnings target, not necessarily a bad thing. Unfortunately, though, it does present a scenario where investors could be disappointed if those earnings don't ultimately materialize. Now, I think turning quickly to the bond market, number one indicator of positive returns comes down to interest rates. What had been a headwind for 18 of the last 24 months seemingly has now reversed course. We heard late last year from Federal Reserve Chairman Jerome Powell. They're actually now forecasting a series of interest rate cuts in the year ahead. Obviously, assuming those do materialize, that would be a big tailwind for risk assets. The focus, though, we'd want them to cut for the right reasons, not as a emergency technique, given a slowing economy, but rather because continue to making progress on inflation and looking to get those interest rates back to their long-term averages. Lastly, on the geopolitical front, this includes a lot of wild cards. First and foremost, we think about the fiscal policy today. That refers to what we spend as a nation relative to what we collect in taxes. Unfortunately, that has been trending the wrong way for a while. We run largest deficit as a percent of GDP today during a non-wartime in an environment where unemployment well below long-term averages. Obviously, that is not sustainable. It requires us to now issue more debt in order to fund that gap. The extra challenge in the current environment is with rates still being modestly elevated, the cost or interest expense associated with more debt increases exponentially. As we think about the global military conflicts, that is something, taking the human toll aside, markets often are able to look past those. Unfortunately, though, the question becomes if the U.S. took a more direct role supporting Israel, or if there was a Chinese invasion of Taiwan, what would, in essence, result? Meaning, what are those implications from a trade standpoint? If all of a sudden we had two large nations that did a lot of commerce with each other. We think about China, those supply chain issues that plagued 2020. Certainly that would be on the table if there was a military conflict that escalated. Now, lastly, I want to touch on the election. If you go back historically, in election years, markets tend to experience heightened volatility. That's a function of the market not knowing what those priorities will be for the candidate in the year ahead. Obviously, that comes down to the uncertainty of one political party or one candidate versus another. So as I mentioned, impossible to forecast what the future may hold in store. However, we take stock from a 30,000 foot perspective. We do see here more red arrows versus green. To me, that suggests the likelihood of another 25% return for the S&P may not be that great. But one thing to keep in mind, as we look at even in an average year, stocks have traditionally provided high mid-single digit returns, very similar for moderate risk portfolios or investors as well. And so, although we're coming off of a landscape that may not be as encouraging, still would strongly encourage investors never lose sight of the fact it tends to be more about time in the market as opposed to timing the market when you think about what translates to long-term success. So lastly, for anybody that's interested, I've included a few bullet points, rationale for each of those factors. As always, available to discuss any of this in more detail for those that would like to chat.